$150 a barrel. Just stop for a second and imagine that number flashing across every financial screen in America. $150 for a single barrel of oil. That is not just a price spike, that is a shockwave. It hits gas stations first, then airlines, then trucking companies, then grocery shelves, then inflation reports. And before most Americans fully process what happened, the entire economic conversation shifts. Because oil is not just another commodity. Oil is the bloodstream of the global economy. Right now, as tensions in the Middle East tighten and production signals shift, energy markets are reacting, prices are climbing, volatility is rising, and billions of dollars are already repositioning across global markets. If you want to understand how an oil shock could affect American inflation, stock markets, interest rates, and long-term geopolitical leverage, subscribe now, because what looks like an energy headline today can become an economic turning point tomorrow. Let's break this down clearly. When oil prices surge toward extreme levels like $150 per barrel, the impact is immediate and widespread. Airlines face higher fuel costs, shipping companies see margins shrink, trucking expenses increase, manufacturing input prices rise, and those costs eventually reach consumers. Inflation doesn't ask permission, it spreads. Higher fuel costs raise transportation expenses. Transportation affects food distribution. Food distribution affects grocery prices. Businesses adjust, consumers adjust, and inflation data begins to reflect the shift. Now here's where it gets serious. If inflation begins rising again due to sustained energy prices, the Federal Reserve faces a dilemma. Keep interest rates elevated to control prices, or risk inflation expectations climbing. Higher rates increase borrowing costs for households and businesses. Mortgage rates remain high. Credit tightens, investment slows. This is how an oil shock turns into a macroeconomic story. But oil markets are not purely economic. They are deeply geopolitical. When Middle Eastern producers signal production cuts or delay shipments, it is rarely accidental. Supply control is leverage, and leverage in energy markets translates into pricing power. Even relatively small reductions in daily output can move global prices significantly because demand for oil is difficult to adjust in the short term. The world cannot suddenly stop consuming energy. Planes must fly, ships must move, factories must operate. That makes oil uniquely powerful. Now let's talk about the United States. America has become one of the largest oil producers in the world. Domestic production is strong, but global oil pricing still affects U.S. markets because energy trades on international benchmarks. If global prices spike, American consumers still feel the impact. At the same time, U.S. energy companies may benefit from higher prices. Their revenues increase. Energy sector stocks may rally. Capital expenditure in drilling and infrastructure may rise. This creates divergence inside the market. Energy firms may gain strength while transportation, retail, and manufacturing sectors face pressure. Investors rotate portfolios accordingly. Billions move between sectors almost instantly, and this is where capital flows enter the picture. Higher oil prices mean larger revenues for exporting nations. Those revenues accumulate as dollar surpluses. Historically, oil exporting nations recycle a portion of those dollars into global financial markets, including U.S. Treasury bonds, real estate, equities, and private investments. If oil reaches $150 and stays elevated, surplus flows increase. Sovereign wealth funds accumulate more capital, and then they decide where to allocate it. Even a small shift in allocation preferences can move tens of billions of dollars. That is why oil shocks are not just about inflation, they are about global capital redistribution. Now zoom out further. Energy has historically reshaped geopolitics. The oil shocks of the 1970s triggered stagflation in the United States. Inflation surged, economic growth slowed. Central banks were forced into aggressive tightening. That period fundamentally changed monetary policy thinking for decades. Today's global economy is more diversified and technologically advanced, but the structural importance of energy has not disappeared. If oil approaches $150 again, policymakers in Washington will face difficult choices. Release oil from the Strategic Petroleum Reserve, encourage domestic production through incentives, engage diplomatically to stabilize supply. Each option carries economic and political consequences. Markets watch those signals carefully. If strategic reserves are used aggressively, short-term relief may come. But markets will also examine long-term inventory levels. If domestic drilling accelerates, energy capital expenditure increases. That means billions redirected toward rigs, pipelines, refining capacity, and labor. Once again, capital shifts. Now consider the global reaction. High oil prices strengthen exporting nations financially. They gain revenue leverage. Importing nations face inflation pressure. This imbalance can influence diplomatic negotiations, trade discussions, and currency movements. Energy becomes bargaining power. For currency markets, higher oil prices can influence dollar flows. If oil continues trading primarily in dollars, global demand for dollar settlement remains strong. But if geopolitical tensions encourage alternative settlement discussions, Even limited diversification could gradually reshape payment channels. Not overnight, not dramatically. Gradually, and gradual change is often more powerful than sudden collapse. For American households, sustained high oil prices could impact consumer confidence. Higher gasoline prices are highly visible. They influence sentiment, and consumer sentiment influences spending behavior. If consumers reduce discretionary spending due to fuel costs, corporate earnings projections shift, equity markets adjust, retirement portfolios feel the impact. Again, one commodity, multiple consequences. The key factor is duration. Short-term spikes create volatility but often fade. Prolonged high prices create structural adjustment. Airlines renegotiate fuel contracts. Shipping companies revise pricing models. Manufacturers explore efficiency upgrades. Governments accelerate alternative energy investments. Each adjustment requires financing. Banks lend. Bond markets issue debt. Investors allocate capital. Infrastructure funds deploy billions into energy efficiency, renewables, and domestic production. An oil shock can therefore accelerate energy transition trends while simultaneously reinforcing fossil fuel leverage in the short term. This dual effect is complex. Energy producers benefit immediately. Consumers feel pressure immediately. Structural change unfolds slowly. For the United States, maintaining energy stability is central to economic resilience. If domestic production offsets global cuts, the shock may soften. If global supply remains tight for extended periods, inflationary pressure could persist. The Federal Reserve then faces a balancing act between growth and price stability. Higher rates slow borrowing. Slower borrowing affects housing, business expansion, and employment. Everything connects. This is why oil at $150 is not just a price. It is a macroeconomic event. It influences inflation expectations. It influences capital allocation. It influences geopolitical leverage. And markets trade expectations long before policy responses are fully implemented. So here's the real question. If oil surges toward $150 and remains elevated, does that strengthen energy producers while weakening consuming economies? Or does it trigger policy responses strong enough to stabilize prices before structural damage occurs? Your answer depends on how you assess supply dynamics, geopolitical negotiations, and monetary flexibility. For investors, awareness is key. Sector exposure matters. Energy allocation matters. Inflation hedging matters. Diversification matters more in volatile energy environments. For policymakers, clarity matters. Stability signals matter. Coordination with allies matters. And for the global system, oil remains one of the most powerful economic levers in existence. Because when energy moves, money moves. And when money moves, influence follows. So I want to hear from you. If oil hits $150 and stays there for 6 months, what do you think happens first? Inflation surge, policy intervention, or market stabilization? Comment below and share your perspective. Because in the global economy, energy shocks do not just change prices, they change power. Stay informed, stay analytical, and remember, sometimes the most important economic shifts begin with a single number on a screen.